Doug, welcome. We're doing a midweek special, or I guess a mid-weekly special.
Yeah, friends, I know you're seeing us with Keith's like he's hiking a mountain shirt, and I look like I'm going outside. But no, we're coming at you today because we had some special news come out over the weekend that a bank didn't do so well. I think we talked about that a little bit on Friday, but that led into a whole bunch of news stories over the weekend, and we just want to give you our opinions and at the end of the day, help you have some peace of mind about your money.
That is absolutely right. I updated our disclaimer over here and said FDIC coverage has limitations. You can go to their website.
Who would have thought?
That is how things unfold, and it is a different world than it was in the 1920s and 1930s when you'd have a run on a bank. Now it happens. The run on a bank can happen right here on your telephone, and that changes things a bit. It probably will change the way that bankers do banking going forward. There'll probably be MBA case studies on what happened with this situation. But we'd encourage calm is the main thing that we would tell you at this point in time. And so basically we had the Silicon Valley Bank that mismanaged their assets and got in a bad situation. The Federal Reserve, along with the U.S. Treasury, was, I think, freaked out by the possibility that other banks would have runs on them. And consequently, I think they created a little bit of the panic themselves. And so did I ever share the screen, or did I? I'm going to show you that again. I can't remember if I already took the share off of this to tell you this is just our opinions. That's good enough. So, but I think when regulators, legislators, or people come out and they are panicked, then it creates those who are listening kind of concern themselves.
Keith, who's the audience for our conversation today?
Well, we kind of outlined this for two different audiences. My mother-in-law was asking me if she should take her money out of her bank yesterday, and I was thinking, the mattress would get kind of lumpy if you did that. And then there's also the young, business people that have money in banks and trying to manage their payroll and things like that. And so that's kind of what when we're putting the outline together, was just trying to address certain things to help you think through the financial matters that really are a big deal to you. So I don't know. At this point, I'm not a fan of what the Federal Reserve and the Treasury did. They allowed those depositors that had more than the FDIC thresholds to recover their money. As for me, I look at the banks and see how much is there. I managed that way for clients over the years to make sure we didn't have more than the FDIC coverage amounts. And I assume that these CFOs and corporate executives that are making those decisions understand those rules and were completely aware of them when they deposited way over the assets. I think I saw something like well in excess of 90% of the assets at Silicon Valley Bank were in excess of FDIC coverage.
Yeah.
So people weren't going in blindly, I don't think, but the regulators came in and protected them, which I think both of us, it's fair to say, are capitalists and would have preferred the market just to deal with that situation and redistribute those assets.
Yeah, I know that sounds cold-blooded, but a lot of times the market is the quickest way to a really good solution.
Yes, and so when the government and the Treasury and the Federal Reserve say that they're not going to use taxpayers' money on this, there's just no way that that's not going to be the case. You and I are going to pay for this one way or another, and no matter what they said, it is just not true. Is if fees are increased at your bank for FDIC coverage, that's a tax, and you and I are paying for that if we have money that's being held at a bank somewhere. And so that's just my view. That could be wrong, but I kind of have that view about the markets in that situation. And so today, this is Monday, the 13th at about 3:00 in the afternoon. And I'm just going to show you what's going on in the market today. The market is up. This is the S&P 500. It's up about 0.6%. The NASDAQ, which is high tech companies, is up about 1.3%. And then where you would see the bank stocks is in this S&P 600. It's down 1.6%. So the banking stocks are taking it pretty hardcore in the face right now, and that sector of the market is struggling. So the other thing we wanted to show you as investors, we've talked about on our show on a regular basis, the VIX. The VIX shows you relative volatility in the marketplace, and we've said a lot of times when it's like this over here to the left of the screen where you see all these ups and downs, that's not a safe time to be in the market. And this dates back over the last year, really. And it was starting to settle down, and you can just see the last 3 days here where we spiked from the 20 level all the way up over 30. And so the markets definitely are not saying it's a safe place to swim out there today. And then the last thing I want to give you a quick look at before we talked about our views of where to put cash right now is I just wanted to show you this. This is the bank that went under, Silicon Valley Bank Financial Group here. It's no longer trading. You can't get out of it if you own shares. It's worthless at this point. But it last traded after it dropped from the 250 level down to 106. I think that's Thursday when it traded there. But we've talked about this for a number of months with you on our show. And we basically said when a stock is trading above this black line, the 200-day moving average here, this is the 200-day moving average. It's a lot safer place to be than when it drops below it. It dropped below it right there on heavy volume. If you see how big that line is, and you had 1.3 million shares or billion shares, I don't know what that number is. That was November the 16th of 2021. So the sellers were coming out of this stock more than almost a year and a half ago. It gave an indication that you could have got out of this thing. Traded up here at $763.22 back on November the 16th of 2021. And so there was time, this was January of 2022 when it dropped below. I'm sorry about that. There was time for investors to get out of this stock. And if I spring forward to today and show you where we've come from along that line, you can see it's been below that 200-day moving average and bounced up to it, but it never got back above it before it dropped. And now it went from that 763 a year ago, January, to zero today. And so we've said over and over, all stocks are speculative. If you have stocks that you think are your pet stocks and you let them drop below the 200-day moving average and just hold on to them because they're a bank that you like, or you know all your friends have their money there, that's probably not going to be a safe way to invest for the long haul. Doug, what do you think about the FDIC coverage for the people we serve? What would you say about that to them and where they're doing their banking today?
If you want to find FDIC coverage, check with your banks, but more than likely your bank is a FDIC covered bank. And that type of coverage can be covered up to a certain dollar amount, $250,000 per account. And so you might want to check your registration, your account. And to have more than that in a bank is probably not a great plan. And it stinks to think that you might have to have 10 banks if you're running payroll for your company. but that's what it is. And there's different types of insurances out there, but the FDIC insurance is the one that's being spoke about today.
Yeah, and I think that if regulators, I think we got the problem we are is because regulators made all the regulations but really had no way to enforce them. Just for example, if we were doing something like what was going on out there, we would have had to send all kinds of letters to those people that were above the threshold to warn them that they're above that threshold and give them fair warning. So if for me, like an easy solution would be for the regulators to set up an insurance level that's higher for corporations than individuals, charge them a higher fee for that coverage, and then it would just simplify the process. And I just got a Murray State degree, but it seems like a reasonable solution for something that would have helped alleviate this situation. But I think we would encourage you guys to have calm with your bank as long as you're below that $250,000 level. The liquidity for those people, even from the get-go, that were at the at this particular bank. I think they were given word very early they could get to their money by today. So 3 or 4 days later, you could get to your money. There's new plans that the Treasury, along with the Federal Reserve, has put in place to give banks some liquidity. I think you can't replace poor management with a new system, but that's just my opinion.
Yeah.
And so I would suggest that if you've got liquidity questions, whether it's with things that you have with us, whether it's with your bank, savings institution, or credit union, just give us a call. We'd love to chat with you about it. Love to encourage you to just stay calm and look to the future with hope.
That sounds good, Keith. What else did you have on your outline?
I've covered basically everything. I had more details about what actually happened with the bank, but I'm not going to bore you with those details.
Yeah,
If
and
you want to know about that, give us a call.
Yeah, give us if you've got some thoughts on that, or you want to hear our opinions on it. We've got them. Keith and I this morning, Keith, me and Phil, we went through I don't know how many stocks, looking at bank stocks, looking at what risk could be for those stocks. And so we've got opinions. We'd love to share them with you, or even get a little more specific about your own financial situation.
All right, you guys have a great day, and just know we're here to serve you.